Hi everybody, welcome to another Bitcoin Intelligence video. Today is Monday, August 25th, and we're going to go over our new report that is going to be published today. So the market was really wild last week, and through today, we had a gradual decline because of inflation numbers that showed the Fed might not be as interested in cutting rates. So that's why we gradually dropped from 117 down to 113 and below. And when the market was almost getting ready to accept a reality with a lot less rate cuts, Fed Chair Powell did the Jackson Hole speech where he mentioned he's actually changing his mind. And that's when the market shot up back to 117, where we were a week earlier, and then gradually began rethinking it over the weekend. And we had a huge sell pressure in the market, which tanked the market from close to 117 down to 111. And then we're back from that a little bit. And today, right now, this is almost at the beginning or a little bit lower than when Powell started the speech. So essentially, the market is thinking this never happened, even though this is a clearly bullish signal. So we are publishing our 26th report. The Fed just caved, got any Bitcoin. And this is going to be accessible to our subscribers. If you want to access our weekly reports, you can just sign up on our platform, 21stcapital.com/BI. And in this report, basically, we go over the macro liquidity and on-chain drivers of Bitcoin. So this week, we're going to talk about Powell's pivot and the rate cuts in the face of inflation and macro dynamics. We will also look at the important on-chain price levels and behavioral indicators, and also look at the liquidity drivers in the US and in China, and from the lens of Treasury and the Fed. So looking at the macro section, again, the important thing was that Powell essentially caved. So everything and the data was pointing towards a Federal Reserve that is going to keep resisting rate cuts. And throughout this year, this has been a clear and central theme of our analysis at Bitcoin Intelligence, that tariffs and Trump administration policies will create an initial drop followed with a rise in the market. And what these tariffs will do is basically to slow down the economy first, and then cause a one-time price shock, which will make everybody think no rate cuts are coming, and actually the Fed might hike. But after that, because consumers are tapped out, they will respond negatively to these price hikes, and they will compromise on other things. And as a result, inflation will not go up as much as people think. And instead, we're going to have trouble in the labor market and economic growth. So we have exactly gotten this idea. And this is another reminder that, analyzing the economy from a position of proven empirical historical data and theory is still much more important than the gut feel that a lot of people rely on. And the rules of macroeconomy stays the same. We base our analysis on those rules, and typically over some time, it starts playing as expected. So we are seeing that finally that substantial effect in the labor market. And that's actually coinciding with the administration raising a lot more revenue from tariffs. So the tariff effect is actually impacting the economy right now. As a result, we do have that beginning a rise in prices, but immediately we are also seeing a pretty substantial damage to the labor market. And that's what really is scaring the Fed. And basically, Powell mentioned that in the near term, risks to inflation are tilted to the upside and risk to unemployment to the downside. Previously, they were kind of initially mentioning, or actually throughout this whole year, they were worried about inflation more because they thought labor market is very strong. And surprise, surprise, they were wrong. And the inflation was the bigger of the two risks. So they stopped bringing the rates back to normal levels. Now he's saying, we're back to equal, but then he immediately says that the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. And the rest of the discussion, he actually clearly mentions that now they are more worried about employment. And the reason for that is clear because in the last 3 months, we've had a lot of revisions that lots of prior data turned out to be wrong. And the economy has added about 35,000 jobs in the last 3 months per month, which is kind of like a third of where the Fed might expect would be the neutral level. And so the economy is really, really weakening. And what they say, this is very important, that they think if labor market weakens, it's one of those gradually then suddenly things where it quickly deteriorates and they will have to be immediately back to the zero bound, zero rates, and then they stay there for a long time and would have difficulty bringing the economy back up to a growing state like they were in the 2010 to 2020 period, where they really tried to cause some inflation and they weren't, and the economy was weak, and rate cuts were not really helpful. Rates were very low, and they had really big difficulty with bringing the economy back to balance in their own analysis. So they are now thinking, hey, looks like labor risks are substantial. Even though inflation is not back to the 2% level that they want, and it's been there for 5 years, above their level for 5 years, but it seems like now they see a lot more risks to the unemployment, and they're ready to resume rate cuts. But the thing is, the speech really sounds like they want to accept a few rate cuts and they hope that this will fix the issue with the labor market. But I really doubt it. I think the way this will go down is the more Trump administration raises money from tariffs, these tariffs are, again, like a tax on economic activity. They're going to slow down activity. And they're going to drag liquidity out of the market and cause firms to, import less, manufacture less, produce less, hire less. And because of that, we're going to see increased issues in the labor market. And that's going to make the Fed panic and maybe keep dropping more than they think right now. So right now, I think the market is predicting a certain rate cut in September and then possibly another one in the rest of the year. But it all, in my opinion, depends on what happens on September 5. I think on that day, we're supposed to get the new labor report. And that labor report, if it turns out to be equally bad and confirm the trend that we saw in the previous month's report, we're going to get more rate cuts. More than September, of course, and this is going to put the Fed really into the panic mode. If it turns out to be really positive, it can clean some of the damage that came from prior report, and maybe we'll stay with just one rate cut this year. But it is possible, and it's very likely that, a substantial change in the labor market like this won't be nullified throughout a month. And it does really seem that businesses are struggling, and it only takes a matter of time before it shows up properly in the data. Now, if that happens, then we're going to see the classic Fed panic, rapid rate cuts, and markets might be volatile, but actually hard assets will benefit from this dynamic because then they'll have to throw liquidity on the market, which will boost Bitcoin and gold and real estate and everything else. that's hard. Again, it is possible that earnings go down and that will hurt the stock market, but um, then they will probably have to go back to stimulating the economies. And the drop we've had in Bitcoin, I think, seems healthy so far and um, expected because a lot of the rate cut hopes have gone away, and equally possible to get all that ground back when rate cut hopes are back on the table. And again, it all depends on how employment progresses because that's where the Fed focuses. But it's generally a good thing that they're acknowledging the reality and ready to make the pivot. But we'll see how that goes. And the rest of our report looks at the on-chain dynamics. This is a fantastic report by Wizard. And this was written a couple days over the weekend where he was mentioning that the fact that we haven't been able to gain back 116 is a negative issue for now because it's below the cost basis of the recent buyers. And now we are much, much lower than that. So clearly showing that the market is still struggling to gain back its strength, but this all is a matter of time. He's reviewing the liquidity trends. It looks like the drop from below 120 was created by a cascade of liquidations in the futures market. And but we have now cleared all those leveraged players, and they are pretty well damaged. And you saw after we went back to this level again, we bounced back up from it. So a lot of leverage is cleared. Not this will create, if you give this market a little bit of time to absorb the recent volatility, the conditions are now clear for a regain of territory if the macro picture improves. He also looks at the rise in open interest, which shows futures market is getting more active. Futures are getting a little bit heated. And again, this is Saturday data. It might change quickly. Futures was getting heated in pretty much everything across the board. I suspect once we absorb this Fed-induced volatility, we will be back in the hot zone again in liquidity, and lots of traders will jump back in. He also looks at supply distribution. We have to clear this region from 113 to 118 to decisively start a new uptrend. These people are probably going to take profit once the price comes back to their level. Again, just like we saw, 117 was the sell zone. A lot of people just want to exit at their break even. But once we clear that level, we are strongly going to start a new uptrend. He also looks at many different charts, or look at the full report to get the details. Then Renault discusses the liquidity dynamics in the market, and I want to emphasize his fantastic summary that he typically provides. He looks at many different metrics: the Fed, the Treasury, and China, and anything else that's important around the world. His analysis is Bitcoin is still strongly favorable. Liquidity dynamics are strong. There might be short-term volatility, but long-term fundamentals are still supportive of global liquidity. DXY going down. It's bullish, bearish for DXY, but bullish for other assets. Ongoing credit expansion and capital flow back into the U.S. Another thing that he emphasizes, which is very interesting, is that money is coming back to the United States and to the Treasury. And this is, again, if you had seen our V-shaped playbook, which we really discussed after tariffs came online. One of our pillars of a Bitcoin new uptrend was the idea, the prediction that money will come back to the U.S. because we had highlighted money had left the U.S. markets after Trump created so much volatility in the markets. But that money will come back. It has nowhere else to go. And when that comes back in, a lot of the essentially bull market will continue. S&P 500 seems bullish with support of global capital inflow, and global liquidity seems broadly positive. China is mildly stimulating, and overall, seems like we are well positioned to restart our move upward, but we have to give the market a little bit of time to reprice the new reality at the Fed. Right now, the Fed is thought to be overall more hawkish, except that the recent Jackson Hole meeting changed that analysis a little bit, but I'm not sure if it has fully cleared the air. So we have to see if another employment report turns out to be bad, then we're going to have the Fed go back fully to their rate cut plans, and liquidity will come back to the market very strong. So that's all I got. Thanks a lot. And again, if you want to access our reports, just sign up online. We have monthly and yearly subscriptions available. And with that, I thank you for your time, and I'll talk to you next week.